Good day. In this video, we're going to show you how to use moving averages the correct way. Not knowing how to trade moving averages can keep you entering into trades going the wrong direction. Confused? Let's talk about it. Now what we're going to do is cover the moving averages that we use. We use the 26 and 55 exponential moving average. We like it because it's really aggressive with understanding price action right now. Because we are long-term traders, when it's time for us to zoom down on a smaller time frame, we actually understand what price action is doing at that moment, because that's all that matters when we're trying to place our entry. So you would notice on our charts, we have a white moving average and we have a red moving average. The white moving average is the 26 exponential moving average, and the red moving average is the 55 exponential moving average. Now, if you are enjoying this episode, be sure to hit the like button. Also, subscribe to our channel and hit the notification bell so you get notifications every time we release a new video. You may be wondering, why do we have two moving averages on our charts? Now, your first thought may be, we trade the crossover. Well, if you're thinking that, then you're wrong. We're going to cover the reason why later on in this episode. Now, before we do anything when it comes to trading in the markets, we always ask ourselves, where's price traveling from? And with using the moving averages, it helps us identify the type of market we are in. Now, remember when you were a child and you started off riding a bike, you had those little round things on the side of your back wheel. Those are training wheels. When it comes to identifying the market, moving averages should serve as that purpose and assist you with your confirmation checklist. Now we're going to dive into the three main reasons why we use these two moving averages. Reason number one, now we hinted at this earlier. Now when price action is below the moving average, that means that it is a downtrend market. In simple terms, when the red moving average, which is the 55 EMA, is above the white moving average, which is the 26 EMA, then we know that we are in a downtrend market. When price action is above the moving average, that means that we are in an uptrend. In simple terms, when the white moving average, which is the 26 EMA, is above the red moving average, which is the 55 EMA, then we know that we are in an uptrend market. When the moving average is running through price action, that means we are in a ranging sideways trend, better yet known as the market reset. The market reset is simply price action ranging in a particular area where the market makers are able to collect as many orders as possible. However, if you want to learn how to make money in a ranging market, just be sure to go check out our video, This Trick Increased Our Trading Account. Now keep in mind, moving averages are lagging indicators, so we do not trade these alone. And now that we understand how to identify market conditions, that leads us to reason number two. These two moving averages actually can serve as an entry and exit indicator. So you notice how price action was ranging and then it broke out of that range. Once price action broke below the two moving averages and came back to retest, that would have been considered a safe entry into the market. Now, no retest, no trade. We really live by that rule because that helps you get into positions where it is a high probability setup. Now, when price action would have come back and broke above the 26 and 55 EMA, that could have served as an exit indicator. However, for this position, because we understood the market gave us a reset, we know there's going to be a healthy pullback. So we would have placed our stop loss about 10 pips above the exponential moving averages. So as price action came back to retest that level, we would have still been able to ride that trade. And once price action continued to fall to the downside and it started to range again to give us a market reset, we would allow this to serve as an exit indicator once price action broke above the 26 and 55 exponential moving average. Now to cover managing the trade, this is going to lead us to reason number three. Notice how price was in a downward motion and it was respecting the 26 and 55 exponential moving average. Then the market provided us a reset where price action then broke above the exponential moving averages and price action was respecting the 26 and 55 EMA. This would be known as support and resistance, where price action was clearly respecting the two exponential moving averages. Now, to reveal the reason why we use these two indicators. We use these two indicators because they provide a double confirmation of the direction of the trend. Most traders use at least one. We use two to confirm the direction of the market. You will notice that we use multiple confirmations because the more confirmations we have, the higher the probability of the setup. Now that concludes our lesson for today. If you enjoyed this video, be sure to hit the like button and subscribe to our channel and hit the notification bell so you can get notification every time we release a video. Also, be sure to leave a comment on any videos you want to see us cover next. Last but not least, be sure to head over to our website at www.thirdeyetraders.com and enroll in our free course today, where we provide you an easy checklist to confirm your trades so you can start making money today. Well, we do want to thank you so much for checking out our content, and remember, we'll see you on the other side.